I'm Jeremiah Boucher, a commercial real estate investor with over 20 years experience. This show is designed to help you build your business, become a better real estate investor, and help you see opportunities that will keep you ahead of the competition. This is Finding Your Edge. What's up, guys? Jeremiah Boucher, Finding Your Edge. A special episode here. I got Rick Cherry with me. He is the CGO here at Patriot Holdings. I'm going to get into a discussion with him about what Fund 5 is, what Patriot funds do, why they've been successful, where we're going in the future, and then answering the nitty-gritty questions about how fund structure works for investors, for active sponsors. Maybe he'll give you insight into what to look for when investing in real estate at a fund level. And overall, it's what's the strategy right now? You know, the best offense is a strong defense. Now, I'm a big sports guy, so we're looking at how do we protect capital and then how do we grow it? And it's not as easy as just going out there, finding a deal and then closing on it, and then the market does what it does and you make a ton of money. So now we're going to dive into it here. So Rick, good to see you. Thanks for being here.
Yeah, the pleasure's mine, Jeremiah. Thanks for having me. I'm really excited to dig in with you. I'm really excited to be a new member of the team, really driving growth for Patriot across all things, and excited to dig in with you here today.
Rick's got a great background because Rick came from a real estate family, knows everything about institutional grade assets. As I keep elevating my game and becoming a more sophisticated investor, and I feel like I've made it to the middle leagues, maybe the minor leagues, but there's a professional league out there that necessarily I don't have to play in, because that's where I don't think the actual yields are as strong as where I'm playing now. But it's great to have that insight, and he has such a dynamic marketing, growth, real estate background. So maybe in this episode, we'll dive in a little bit about that too.
Absolutely. Yeah, I'm happy to dig in as far as we want to go. But the long story short for me here today, Jeremiah, is how can we help the world see the essence of you and of Patriot and ultimately all the wonderful things that you've accomplished to date? So, Jared, tell me a little bit about your journey from green to Gandalf, from zero to hero, starting in the weeds, in the trenches, and ultimately finding your way as a CEO, a founder, executive of a very well-established private equity firm.
Yeah, so I grew up a knucklehead where I was, I love sports. I loved just getting, I thought I was going to be some type of football player. I'm a short, slow white guy, so that didn't work out. So, but real estate was my competitive passion. So I got in real estate young, dropped out of college, and got into the mix of it right in 01, 02. Rode the market up, had no edge, bought a bunch of houses, lost everything, 07, 08. Learned a lot of good lessons. And I'm actually glad I went through that period of time, because real estate does not infinitely go up, or at least in the short term. So that caused me to get into mobile home park investing. I mean, I've talked a lot about it. And that was the niche at the time. And mobile home park investing was interesting because I could buy it coming from nothing, right? Scrappy, where I had no credit, no money, no experience, but yet I had to find an angle where I was kind of pushed out of the core four, apartments, retail, industrial, office. Anyone that's in real estate investing, it's a pretty tough jump to go from buying houses, flipping houses, renting houses, and then jumping into that next level of commercial real estate. So it was like the good old boys club. You look like you're 13 years old. You don't know what you're talking about. You got no money, and I'm not a pretty girl. So it's like, there's not a reason to work with this guy or even engage with him. So I felt kind of shunned from the industry, and a lot of egos in the industry too. So, they got that little chip on my shoulder from the beginning. And I just said, I'm going to go find my own way. So I don't need to go through a broker. I don't need to be a broker. I want to be an owner. Not knowing anything and not having money, that's a problem. So I found a guide, and I think that's critical. I had to learn to actually be a player and not a coach, and humble the ego, and found a real great mentor of mine who was starting his fund, had 20 years experience in mobile home park investing. I knew that these land lease communities provided affordable housing for people, and there was not an institutional market for it. And this guy was straightforward, his name's Dave Reynolds, just the godfather of buying investment in mobile home parks. And bought his course. He was teaching it. He had an online marketplace to buy and sell parks. And that's where I jumped in. I'm like, hey, Dave, I want to build myself in this industry. What can I do? And he said, go find deals. Whoever's got the deal, they control the entire process in the business. So that's where I hit that cold calling for 30,000 calls a year for 10 years, and out there just not getting too in my head. And there's a lot of times where I'm like, what am I doing out here? I don't even know what I'm doing. And there was a lot of lean years, but that was it. That really allowed me to understand under his guidance, what's a deal? What's not a deal? How do I protect the downside? Where can we really get burned? And then sitting back and being patient on that and not getting a nice check like I did the first time with making some money and blowing it and losing it, and just reinvesting every dime back into the company. So to this day, really the focus is on alternative commercial real estate investing. Reason being is I really believe right now we need to protect that downside. If we don't have tens of $millions of capital, right? Great real estate investors, even the best of the best, reading Sam Zell's book and seeing that this guy had hundreds of millions of dollars of real estate in the 80s, and he still was cash strapped to make payroll on it, having less than $100,000 in the bank. Like cash is tough. Liquidity is tough when you're a deal maker. So understanding that, learning, okay, these assets that serve the masses, right? Another mentor of mine said, serve the masses, live with the classes. I don't need to serve the classes. I want middle America. People need mobile home. They need affordable housing. 10 to 15% of Americans live in one. Self-storage investments, 10 to 15% of Americans have one. And small bay industrial, contractor units. I grew up paving with my dad. We go to the shop every day, and you get up and you got your work boots on, and you can't work out of your house. You can't have trucks all over the place. So it's for me, it's like that's such a bulletproof strategy long term, but yet it's also a niche that is not institutionalized. It's fractionalized, right? Lots of mom and pops all over the country own these. So that's the thesis, and it's worked out pretty well over the years. Been hitting, and the heyday of these deals, I was putting together individual syndications, just finding friends at conferences, older real estate investors who are in the game. They know it. They don't want to be out there hustling and doing what I'm doing, hitting the phones, meeting people in the middle of Plainview, Texas, and there's so many stories about different sellers and their situations, but getting out there, finding the deal, and then delivering these returns, hitting 30, 40, 50% IRRs. But as I scale, peeling back, we're hitting 20, 25% consistently. But it's a ton of work. I get a lot of people that think they can just graduate into buying commercial real estate. But yet at this stage of the game, it's not 10, 20 years ago. Information, access is everywhere. So the deals, like anyone sees a deal come on the market, it's not a deal. So, and there's a lot more to it than just buying a piece of real estate and hiring a management company. I'll just keep blabbing on, but it's just, we're vertically integrated. So it was like, okay, I had my first win. I sold my portfolio that I aggregated together in mobile home parks, and I made that first $10 million in 2019. And it felt so good to actually, for 15 years of investing, to validate that I did something, even quitting college, and my parents were just questioning, what are you doing with your life? And there was really no money up into that. It was just boom, one pop. But right there, that was, okay, well, actually, we don't even have a company. I'm a deal maker. That's all I am. And then I'll admit when you're lucky and when you're good, and I believe I was good, but there's also a level of luck where the market just had a bull run for 10, 15 years. But then I realized there's weaknesses in the system, right? And that weakness was operations, financial, in terms of accounting, financial reporting. And then there's just levels, right? You just keep seeing better and better levels of where the game is at. And now other competitors of fundraisers and investors, anyone out there that's doing it, like you just keep seeing the bar raised. So you just got to innovate and evolve. And that takes capital. And rather than going out and buying a nice house and cars and all that lifestyle stuff, like for me, like my dream is having a badass in-house legal counsel advisor, a really amazing CFO with an accounting advisor, and then a dynamic team so I can eventually have my own family office. But those are assets to me. Those are actually flashy assets. It's not driving a fancy car.
I love that. Over the years, it seems like you've collected a pretty solid blueprint, right? It seems like Patriot has a way of working, a way of looking at deals, a way of operating. What does that blueprint look like? Is it always buying at the right basis? Is it not trying to time the market? Is it throwing the crystal ball on the ground and just, again, sticking yourself, handcuffing yourself to the right fundamentals at the right time always? What does that look like for you in terms of finding deals, hunting out the heroes for funds, so on and so forth?
I think the unique niche of real estate is that it's a very inefficient market. And that's the beauty, is the challenges and losses can come from inefficiency, and also the asymmetric gains. And what I mean by that is there's always a story. Like, you have to, and it's a relationship business. It's people trusting each other, working with each other, and solving problems. And I'm not a spreadsheet guy. I mean, I dig into the models, but that's not my strength. My strength is finding opportunities where there's real motivation with people. And the great thing about these assets that are alternative real estate assets is they take a lot of work, like I was saying. So they're management intensive, capital intensive at times. And these people that started these businesses, salt of the earth, they built this with their company. They built this themselves with their bare hands many times. These mobile home parks and storage facilities, they're phasing out. It's a different era nowadays, and it's not sexy. Running that business, you're dealing with a lot of people and challenges. So in my eyes, that's the greatest opportunity. So the thesis is there are businesses that people need. And when I mean businesses, I'm saying self-storage, mobile home parks, small bay warehouse. It's a real estate-based business, and that there's inefficiencies that we can solve, and we can work with people that we can acquire their asset at a fair basis, with real upside, and still protecting the downside. And I've looked at all real estate asset classes, and that's a very rare opportunity where, a lot of times you can build a big industrial building or buy a $40 or $50 million apartment complex like Grant Cardone at a 3.5 cap or whatever it is in that market. And there's very, very little margin for error, but it kind of it makes you, in my eyes, get fat and happy and get somewhat complacent, where that capital gives you that safety net, where in the beginning, anyone out there graduating to this level of real estate, there's not a lot of room for errors. You can't just throw capital at something and just sustain something. You have to be precise in that, where the metrics, this is the attributes of the asset that I know will be successful because people need it. It's highly visible. There's good demographics in the area. The product itself is something that's usable by people, and it's priced fairly. So it's a business first, serve the customer, the masses, and then the rest will take care of itself. And now we're going to generate the yields for our investors. But people forget that. I think common sense in real estate can get lost with spreadsheeting something, looking at it from a lender's standpoint, or just looking at past performance. I mean, you're serving people in this product type.
So in today's market, Jeremiah, we know that fertile ground exists even in frozen markets. We know also that our most recent Fund 5, is now actively taking down very attractive properties that are resilient in even the toughest markets. Could you help us profile a deal that you're excited about, either that we've already acquired or that is in the pipeline?
Yeah. So, I mean, ultimately, all the flashy PDFs and all the videos and all this content, it all boils down to the deal at the end of the day. So, and the fund structure, we'll get into the fund structure itself, but deals themselves. So a couple I'm excited about. First one is we bought a industrial storage property. It's mixed use, and it's in a town. It's college town in New England. Good demographics. And why I love the deal is we're walking into equity. And we didn't just walk into it, but we created it during the escrow period before we even closed on it, which I love for investors because you de-risk the asset where there's still value creation, but you're not taking that big risk. So I'll walk the audience through it. When we bought the property, there was a national company that was credit tenant in the industrial space, but they were building their own location, and they were selling this. And there was 100 units of storage behind it that they vacated. And because they're such a big company, they didn't even run the storage facility. It was sitting vacant for 5 years. So what was great, it was located on Main and Main, I mean, right there in the middle of town. And we already own an asset in the area, so we know the analytics of where the rents are and the demand. And the beautiful thing is sometimes It's serendipitous where we have the industrial asset. We're thinking we're going to go have to release it. And during the escrow period, the broker approaches us where we were very aggressive on the price. I was, regardless of us having a tenant, I wanted that asset. But then now the broker saw that we can close in a very quick period of time. So he brings a tenant to us during escrow. He had it in his pocket the whole time. He didn't tell us. And that tenant is a national electrical contractor, grade A tenant. They're going to pay. Great business model. So we already had that space backfilled from the other national tenant that was leaving. We got $9.50 triple net per foot and filled that whole building up. So right there at our cost basis, buying at $72 a foot. Now we have all the income that covers all of the debt that we're taking on with the property. It's cash flowing day one. And then we have 100 units that we, during escrow, already start getting in there and making some minor improvements, start marketing the property. The second that we close, and we actually had to close quickly, so we closed with hard money. And that allowed us to win the deal. And then we turn on the spigot, and marketing. So it's that marketing machine got turned on. Now we've already filled up 15% of the facility. We're in May now, so five months in, and it's a big win for investors. And the focus, why it's a big win, is not only the big payoff in 5 years when we close out the fund. It's that cash on cash that each month we're hitting that 5, 6, 7, 8% coupon for our investors, annualized, and that gives a lot of safety and consistency that is needed right now, because a lot of the real estate investors did well over a 5-year period of time, but the big wins were on the back end. And right now, you just can't count on the big win. We want that consistency day in, day out. And that's where these asset classes that the alternatives, they really shine. We can get into a couple other ones if you want too.
Yeah, I think that'd be really nice. Let's talk a little bit about Syracuse specifically, a self-storage facility that we just took down in New York. Again, that's now under the Fund 5 umbrella. Any insights or details that maybe you want to share with our audience today?
Yeah, so we bought a large storage facility in Syracuse, another college town, diverse industry there, right? Older town that has a lot of population relative to the markets we're in. And that asset's intriguing because this actually was not a older mom and pop that was phasing out. This was a investor who savvy, he understands buying and creating value, yet he had a life that he had to shut off his investment partnership with, and he had to sell the asset and close it out, which was opportunistic for us because he filled the asset to 65% occupancy. Stabilized in our industry is around 85 to 90%, where you can count on that's where you're going to stay at occupancy. And he sold it at a discount. So we got it at $5 million. It was sub $100 a foot, well below $100 a foot. During the appraisal process, it was valued at over $7.5 million. So and that's an appraisal, right? That's after stabilization and value creation. But it's nice where you're debt covering day one, so we can go in and we can make sure we're paying the debt coverage to the lender, having a little bit of cash flow left over. But there's so much opportunity where there's no marketing being done at that facility. So it's like, I know this, it could be boring to people watching this where this is so nitty gritty. But if you're a real estate investor, the devil's in the details, right? And high traffic, very little visibility. No one knows it's a storage facility. There's no signage. It's not heavily promoted on Google Ads. And people get storage. It's not like they research for months to find a storage unit. It's, I have, there's a death, there's a divorce, I'm displaced from my job, there's distress in my household. Like all of that stuff is like, it's a pain point process. And I want to solve that pain point right now. So pick up the phone, look online and fix my problem and try not to make it that difficult for me. And when my mom got divorced, that was it. I mean, I was grabbing her stuff and just pulling it out of the house and putting it in the storage unit while she's crying. Mm-hmm. So it's like, it's not a process that people enjoy. So we try to make it flexible, friendly, fast. That is really the goal, to solve that problem. And that's where it's convenience and it's not rocket science, but that filling up that 30%, that creates $2.5 million of value. And it's boring metal buildings with people's consumer goods, but it's a reality of what we need. So I think it's a great asset where long-term roof's good, paving's good. And the beautiful thing is we were able to monetize the parking lot and rent out to UPS where their lease was month-to-month lease, very low. It was $2,500 a month or so, and they really weren't going to commit. And then the second that they realized an operator, a savvy operator, is going to go put it out to the market, and we're going to go look for other outdoor storage, which we've talked about in the past, how attractive outdoor storage space is now for lease, industrial outdoor storage. They immediately jumped on that $5,000 a month, doubling their lease payment, signing a longer term lease. Now we monetize the parking lot, and we still have the cash flow from the storage. So it's just, those things are fun. In commercial real estate, the creativity to be able to cut up the deal and look at different components of buying a deal and creating value, and either selling off and de-risking, or creating more value by subdividing or monetizing an empty parking lot that perceivably has no value. We're buying a deal right now in Pennsylvania where we have some huge wins in Pennsylvania. It's a mobile home community. And the nice thing is, it's the cherry on top was not only that the property cash flows, but we got the oil and mineral rights, the gas rights, and that monetizes to $45,000 a year in additional NOI. There's no expense. We sign a lease with an oil and gas operator, and no one's drilling on our site. This is the ability to run the lines that can't disturb any of the day-to-day business of our tenants. But it's just, man, it's just beautiful to see how I can take these pieces and put them in place, and then we can serve our investor by providing the returns that they're looking for, using their capital, though, that to help go out and acquire assets that we can leverage, where we're getting good bank debt on the assets, and just these levers like that. That's the greatest part of commercial real estate, where other, I think residential, there's nothing wrong with that type of model. It's just, that seems so commoditized, and it's just the same thing over and over. And in commercial, there's so much opportunity out there when you have the vision and insight to see where you can pull on these value creation levers.
Yeah, you painted such a nice picture about how we essentially aim to take the boring and create brilliant outcomes for ourselves and our partners. And so looking forward, now we've talked a little bit about both an asset that we've recently taken down, an asset that we're currently ultimately operating that's in the pipeline. Tell me about your favorite win, whether it's from a past fund, maybe it's the mobile home park 8-pack out of Pittsburgh, or something along those lines that you're so proud of, both in terms of the returns that it delivered for our partners, but ultimately also what it did for us as a team at Patriot.
Yeah, I got two that stand out in my mind. One of them is an asset we're buying right now. So it's not a realized win, but it's been the same thing I've been doing for near 20 years. It's a mobile home park in Nebraska, so it's in the heart of the Midwest. A lot of tough jobs out there in terms of meat packing, industrial manufacturing. Affordable housing is critical in these markets because these are the dirty jobs people don't want to do, but they're the heart of this country, especially industrialization with what's going on with trade tariffs, and you can't outsource meat packing. That's not how. So it's going to be done here until we start growing meat, and I still don't think people are going to be all in on that. So this asset is cool because I love the strategy of I'll pay your price if you use my terms, or I'll pay your price, work with my terms. So we paid somewhat of a premium price on the acquisition. And there's a story back there, though, where I met the father of that asset. It was 13 years ago. I was struggling at the time, too. So I literally thought I'd have to sleep in his model home. Like I was running low on money out there. So stayed in some 100-year-old Adobe hut motel while my friends were out partying. And I was getting a call on Friday night, and I'm in this smoky thing. I had to leave the door open. It smelled so bad all night that I was like, what am I doing, man? My friends are having fun, and I'm in Nebraska. I don't even know why I'm here, but I think I can buy a mobile home park. Well, fast forward, he passed away. The family owns the park now. They did a good job running it. It's a really nice, clean community, 150 units. So we're paying $6 million for it. But the beautiful part of it is they don't want to pay that big capital gains tax, and they're not interested in going buying another mobile home park or buying some other real estate asset. So we created that installment sale. They're carrying the mortgage. We get very, very good leverage. We're putting down roughly $1 million, so 80% LTV. But we're getting a 5% IO interest rate, interest-only rate at 5 years fixed, 3 to 5 years fixed, and then it's a 40-year AM after that when it converts. So the debt itself allowed us to lock in a very low service of debt, the payment that we need to make to the seller, and allow us to cash flow, even though we paid a very fair price. I mean, it could be a premium price, but it's actually allows us to generate within the first 6 to 12 months, $20,000 a month in cash flow on that asset, which is a great return on equity. So that provides our investors cash flow coming in. And then the nice thing is there's such a high demand for housing, and the owner had a mobile home dealership. So people that don't know mobile home parks, these mobile home parks are filled with people that actually buy a mobile home and put it on a lot. Or in the old days, it was a dealer. So you would have your access to, as a dealership license to buy from a factory, buy the home, put it on your lot, and then sell it to people. Or people in the past would buy them and put them on their own piece of land. So that guy did this, and this was a big business model for 30 years in the U.S., and there was some economic crash before the Great Recession where it got out of control and all of that business got flushed out. But the real winners are the people that are actually still thriving in that area are the mobile home park owners, the landlords that have the property, because now we have the infrastructure that was built 30 years ago or 40 years ago. And now we want to monetize these vacant spaces. So we're going out and buying mobile homes, and there's a reputation that this guy has quality mobile homes for sale. We just need to inject some capital, put them on the lots, and sell them to these qualified families that have good jobs. They're good paying tenants, and they can own their own home on our site. And then we can fill it up with brand new homes. And when people hear mobile, they think of old trailer and trash. And these are nice. I mean, they are vinyl siding, shingle roof. Drywall inside. It looks like a normal home when you're inside it, especially a double wide. So we can provide that service and value to allow people to have home ownership that normally they could never buy a home. It's a quality home, have a yard. And secondly, they can afford to pay a $350 a month rent. Right now, I think the rents are $290 a month. And really market rents are closer to $400. So we're going to raise the rents gradually to get them there. But that's a very affordable payment for anyone in this country. And that allows us still to get a high yield. We can increase that return year over year and knock it out of the park. And it's a win-win for the tenants and for our investors. But that's like a blueprint of exactly what I love to do. And then I feel that the risk is mitigated or the downside is protected because we own the land. We don't own all the homes. I'm not dealing. I've had apartments. I've had homes. That's a lot of maintenance, a lot of deferred capital improvements, roofs, toilets, turning a unit, carpet, paint, all that stuff. I mean, I love the model from the beginning. It's boring, but it's sexy in my eyes because you're leasing a piece of land. You provide water, sewer, trash, roads, and power, and that's it. And we build that back. They're responsible to actually pay for it. That is the model for that deal in our fund. I can get into like a past win as well if you want me to.
Yeah. I'd love first to help the audience understand from a team perspective, right? I mean, you just talked about a lot of different elements of value creation, right? And what we know is ideas are easy and execution is hard.
Yes.
The team that can execute on those ideas, on that strategy is certainly worth its weight in gold. And from that perspective, right, what's your approach for finding the right people for this long-term game? Something I hear you say often is, I'm in the game of winning long-term games with long-term people. Yeah. And so from that perspective, how do you go about finding those right people? And ultimately, how do you see them fitting into the value creation at Patriot?
Yeah, the best companies, the best CEOs, I've now highlighted, it is your talent, period. I mean, from the Blackstone, BlackRock's, private equity firms, you're really buying into the smartest talent in the world that are acquiring companies and creating value, driving value. And that's why the biggest investors align with them and invest hundreds of billions of dollars, if not more. And then on a smaller level, as you scale and grow a company, I saw it the other way. I saw my dad never hire talent. He never trusted a partner. He never scaled his business, and he was a slave to his business. And I admire his work ethic, and I embody it. And he's willing to do any job. He's not going to ask someone to do something he's not willing to do. So, I mean, that to me are these character traits that I love. The problem is, though, he can only work so hard so long. I mean, he's the boxer at the last quarter of his career, and you cannot fight another fight, even though the payday's there. So he's done. So I don't want to be in that position where I spent my life because I wasn't willing to sacrifice some of the cash flow or profitability or trust in. You're not going to be perfect. Like, I don't care who you are. I went to Alex Hormozi's, business building conference, and then we had a one-on-one, and he analyzed my business. And it's talent driven. I mean, yes, you have to create sales. You have to understand your asset or your business model, and you have to create value for the customer. But if you don't fulfill the value, forget it. You're done. And I've met that point in my career, hitting milestones time and time again. And I wasn't ready for it, right? I wasn't ready to be a dynamic CEO at any point until I learned the pain points of where are we not, where can we excel? Where do I feel like we're not to our standards? So to answer your question directly, that was a roundabout way of saying it. But to find talent, I have to have the standards and the culture that I want first. So the reason I call my company Patriot Holdings is I'm from New England and I love the New England Patriots, even though they're horrible right now. They are the dynasty, right? It's hard to deny that they are the one of the greatest sports organizations in the world, and it was based on culture. I mean, yes, they had the greatest quarterback. Yes, they have the greatest coach, but that was created through the culture. And the culture was created that what you get is what you tolerate. And there was very little tolerating things. And Bill Belichick and Tom, they weren't there to make friends with everybody. They were there to set the standard that we are going to be the best we can be day in, day out. And that's what they did. So to me, what I was interesting about reading Bill's book was that the culture wasn't Bill barking at everyone saying this is the culture. The culture was created by Bill having key captains he drafted for key leaders that were either experienced vets or young guys that were leaders. And then he brought them together and he said, this is the culture. I've coached the best players in the world, Lawrence Taylor and under Bill Parcells. And he knew, okay, if this is the standard you want to be at, this is where we have to be as an organization. And it's up to you. You have to drive it. They're going to model you. People don't do what you say. They emulate what you do, or they're out. So I love that, is that for me, bringing in key leaders is not just executing on filling lots or on driving rents or you and marketing. And hopefully someone sees this because of you. So it's really about, what's the culture that they create? What are the standards that they tolerate in the organization, and do they align with those things? And I thought this was rah kind of crap, 5-6 years ago, where it's like, let's do your job and get to the heart of it. And that's really not always the case, where you can have an A player, like in football, like an Antonio Brown, a really, really talented player on the team that can score points, but every other aspect of his personality creates toxicity in the organization. And I've been subjected to tolerating that because I was afraid. It was the scarcity mentality that if I lose this one person, then it's going to truly affect my business. And I don't want to go through that pain right now to retool that position and rehire and train. But the problem was I just created more weakness in the organization, because then that person then starts to infiltrate everyone else with their behavior. And then you compromise who you are as an owner or as a builder. And you also, you're not being really direct with the person because you're so afraid. In any relationship, I can't stand when fear drives a relationship, because then it's truly not built on love, on expansion, on growth, on positivity. It's a manipulation. So that's more of the psychological aspect of it. But ultimately, these A players that I bring in, I want to make sure they're passionate about what they do. They have pride in their job. They're accountable, that they do what they say they're going to do. They are a team player. That's a big one. Is a team player learns and he teaches. It's both sides of the equation. They're obsessed with getting better, right? They're resourceful. They find a way. We're not a huge company that has every SOP dialed in. They have integrity. We deal with people's money. We deal with people's housing. We deal with people's stuff and their businesses. And then they're tenacious, right? If you're clear on what you want to achieve, then you can absolutely apply all the effort to achieving that. And the tagline is, you find a way. I mean, that's what we do. We find a way. So that's what I'm grading on first. And I before I look at their skills, and now I'm able to have the talent pool where I can draft up, because I actually have some better financial resources and we have the culture already in place. So I'm not trying to organically shape people into who I want them to be, I'm already looking at everyone else is vetting them out. And that's where it's like, okay, now these guys embody this. Do they have the skill? Do they get it? Do they want it? Do they have the capacity to do it? The skills and talents. That to me is like, okay, I can deal with people that maybe don't have the exact technical skills that we want, but they embody all those other areas. Man, those people truly create massive companies. I mean, I'm very, very clear at this stage on that. So finding these people, in my eyes, is at this stage, I like to. I don't want to have to train them from the ground up. I've done this over and over again, hiring friends, family, new talent. And there's nothing wrong with new talent. There's a role to put them in. But in leadership positions, I love people that have been through the trenches. They've seen good cultures. They've seen bad cultures. We just hired a mobile home park director. I'm really excited about, and it comes from Sun Communities. It's a public REIT. And that public REIT has standards that are very, 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 very value driven, where every decision he makes, he had to be held accountable to a public board and talk directly with the CEO. And it's just that's great to have that type of leadership in the organization. And then on the other side, it's new talent. I mean, we've hired sales guys where they came from car sales, they came from brokerage, and they are thriving because they have that tenacity. They want it, and they embody that they want to get better. I want to feed people that want to get better. I don't want to support people that just want a paycheck.
Well said. Well said. And so now that we've talked a little bit about the team, right? Ultimately, I know you hang your hat on the creative ingenuity behind every deal, right? In today's market, tell me about that creativity. Tell me about whether it's on the deal flow side, whether it's on ultimately the execution side. What do you love to dig your hands on, and really get into the nitty gritty on?
So creative structures today, where it can get interesting. First off, seller financing, it's the foundation in commercial real estate of a great strategy where I said, your price, my terms. And people think that it's not that popular of a strategy, but I mean, people don't know. I mean, this is a fundamental strategy that's going on since the inception of commercial real estate. I mean, there is a tax problem out there that everyone's incurring, and it's 37% in terms of ordinary income and 20% capital gains. But all that depreciation recapture, all that stuff, if you're a real estate investor, at the end of the day, all the person is saying is, I don't want to pay Uncle Sam what I don't have to. And the fact that we can structure a deal where we can buy it at a favorable price, we can make an installment sale, making payments to them, and they can get a return on their equity. They can make 5, 6, 7% on their equity. It's a really great win-win situation. And when I'm old and gray, I'll work with somebody that I'd seller finance, get a 6, 7, 8% dividend check where I'm the guy that I don't have to run it anymore. I don't have to deal with anything. And then this guy can handle the tenants, just pay my check. And if you lose it, I get it. If you don't make your payments, I get the asset back and I'll do it all over again. That's number one. Number two, I think it's looking at the components of the deal, how to monetize every piece of it. Like I was saying, so oil and gas rights, additional parking. Can we do revenue management where we're selling tenant insurance and driving additional revenue on top of our storage units? We're doing some specific build outs on our TIs for warehouse tenants where they're paying premium rents and signing longer term leases. So where, cell towers, any part of that equation that you can pull out and either sell off that portion of the real estate, de-risking you. We've done this many times where we subdivided a piece of land and sold it off to a car dealership and monetized something we never even put value to. So it's just where can we create value that's outside of the pro forma there? And then the third thing we've noticed is sellers have been doing leasebacks to us where they have a contracting company, right? And they want to stay at the property for 2 or 3 more years, but they don't want to run the real estate anymore. They're signing a nice 2, 3, 4, 5-year lease with us and immediately starting to monetize and pay us to run and own their property without us going to have to go find a tenant. So we're walking into the revenue, and the guy's, in our eyes, I mean, he's the best paying tenant they're ever going to be. I mean, he just cashed out $3 million. Now he just wants to ride out his days and be done with his business. So I think there's a lot of levers to pull, but I think to the question where I think it speaks to in real estate right now is it's no longer lock in the lowest interest debt, right? Find as much equity as possible, and then go out and buy as much as possible. And then the market is just going to go up due to excessive inflation and economic growth with rents. And that's a place where I notice stepping in to the private equity world versus a deal maker, of being a bootstrapping real estate investor. Now, the private equity world makes money in funds on fees. And if they aren't deploying capital, if they're not raising the money and then go, and you know this better than anyone, and if they're deploying it, putting it out in assets, they don't make any fees. There's a lot of people with Ivy League educations that need big paychecks. And they're there with a very big overhead in nice big glass office buildings where they have to deploy capital and raise. And I'm not saying that's always bad, but that incentive in its own, though, is, I believe, somewhat of a conflict where if it has to be a machine where you have to deploy capital just for the fact that to keep the lights on, then I don't think the alignment is there where you're really just trying to find the best investment possible to deploy money into, regardless if it's investors or I'm the investor myself. And we talked about this before, and I am one of the biggest investors in Patriot because I believe I drank the Kool-Aid. Like, this is my life. My wealth is tied up 80% plus in commercial real estate assets in my funds. So I love that alignment of interest. And I'm rambling on, so I'll just keep going though if you want me to.
Please do.
Okay, so what I talk about is like whenever I'm investing in someone, because I have friends in real estate and they bring a sweetheart deal, I'm open to it. I'm a deal guy just like anybody. So I'm going to ask them the 6-point jockey test because the age-old Wall Street saying is you bet the jockey, not the horse. And the horse is critical, right? Because you have to have the horse that's going to get over the finish line, and he's got all the attributes to win, and just like any asset or investment that you're going to get into. But if the jockey doesn't know what the heck he's doing, or he shows up to the race drunk, I mean, you're done. Like, you're not going to win the race. So you're really, over time, consistently, that jockey is going to continue to find a way to win. So with any sponsor, I'm asking them, number one, what does the business do, or what is the investment purpose? What's the problem it's solving? And if I don't understand it in 2 minutes, I don't want to invest in it. No more AI, no more clothing brand companies. I've done a lot of them, sports leagues and stuff, just little stuff here and there. But, it's just in my eyes, I don't want to invest what I don't understand. And this is very simple to understand. So secondly, it is, what else are you working on? Because if they're doing 5 different things in 5 different industries, it's just hard for me to believe that they're going to be focused on my investment. So I want to know that you're all in. Third thing is, how much skin in the game do you have? And that's like, I want to know you got all your money and credit and time and family's money behind this thing, because it's hard to walk away when it's your own cash. It's human nature. Fourth is, who's your team and why'd you choose them? And like you said, execution is everything. Everyone has a good idea. Tons of founders out there have great ideas, but founders, I'm not investing in founders anymore. I need to know who's the team and why did you choose that team? Next one is, tell me about a time where things didn't work out. Tell me about a time when you failed. And if they say, well, I've never failed before, you haven't been battle tested. Like, you're not in the game enough. Everyone has failed in business. And if you're not going to share it with me, then that's an issue. Because if there's no transparency, I don't mind bad news. It's life. This is how it all works. I want to know, though. I want to be prepared so I can help guide or assist, or at least be prepared for whatever bad news is coming with my investment that I trusted or entrusted with this person. And then lastly, it's a gut feeling with somebody. It's like, is the jockey willing to die on the horse? Like, are they going to do whatever it takes? You can see it. You can see that look in someone's eye when they want it so bad. And I've seen young guys that have created amazing companies, and you just felt that energy. It's palatable. It's contagious. It's like an obsessive drive that they have to achieve this thing or they can't live. You know what I mean? I was watching a documentary on Nikola Tesla, and this guy, to figure out how alternating current worked, he damn near killed himself. In 4 years, he could not stop. He could not rest. And Edison said it was impossible. And this guy fucking wanted it so bad that he visualized this thing day and night. And then he was walking in a park and it just clicked. And he finally figured it out of how to make this happen. And that's why we have lights now. Electricity is the way it is. So to me, that's inspiring. And I'll bet on somebody that is that inspired and that hungry and that focused, and they embody all of those things because that's what capitalism's built on, America's built on, why it's exciting to get up in the morning. And like, if I'm working a job, there's nothing wrong with 9 to 5s. It's just a capitalist, an entrepreneur, an enterprising person. Like, if you don't have that hunger and drive, like, forget it. If you have to watch any video, social media video to get you amped up in life, I mean, we all have downs, but if this isn't your nature, then don't even step into the arena, because you got to be the best of the best. And if it's not who you are, forget it. And I see too many people today want to embody that hustle culture, that I'm an entrepreneur, just because it sounds good that I'm an entrepreneur, and they don't have it, right? And you don't have to be the owner. You don't have to be the founder, but to sit in a leadership role and be a partner and be part of a team where you embody the ownership attributes, that we're all creating something together and we either die together or we win together. Like that is just something, you either have it or you don't.
Yeah, 100%. I mean, so many good sound bites there, Jer.
Yeah.
And so, for me looking forward, let's bring it down to ground zero specifically for our audience. And let's talk about today. What does Fund 5 look like? What's a winning outcome for one of our partners in your mind? Whether that's helping them see what a cash flow current looks like over the first 2, 3, 4, 5 years of a fund right through close, or whether that is just, how we are ultimately going to create long-term value either through preservation or growth, right? How are we going to serve their family best?
What a win looks like in Fund 5 is we are raising $25 million right now. We raised about $5 million of it. With that $25 million, we're going to go deploy that in the next 12 months. And we're going to go buy assets that are cash flowing damn near day one. So we protect the downside first. So our focus is an 8% return to our investor. That's the preferred return. And that is the before anyone gets paid anything, that is what the investor gets in the first bucket of profits. So the way that works is we're going to buy probably 15 assets, anywhere between $2 and $10 million. And on those assets, there's always going to be a story. There's always going to be somebody that wants to sell with some motivation. And we're going to be able to implement the playbook on that asset to drive revenue and lower expenses. At the end of the day, first year, the goal in the fund is raise the capital, and then secondly, it's deploy it. So there are assets cash flowing, but it's somewhat of there's a lot of moving parts in the beginning of the fund, because the reason I did the fund is having 10 to 15 assets allows us to de-risk. If there's any one asset that doesn't perform like it's supposed to perform in the short-term timeline in the first 2 years, there's other assets that will, because we'll bat an 80, 90% ratio here of strong performing assets. But there are always intangibles that you cannot control in the short term. So for us, the fund, all the assets in the fund that we acquire, pool together the cash. And then that cash then gets distributed to the investors. And we keep a very strong buffer of cash available, $1 to $2 million at all given times for us until we wind down the fund, to protect the downside for us. So with that being said, these assets in the beginning are going to generate anywhere between a 3 and 8% yield the first year of operations. But we're going to be buying all these assets the rest of this year in 2025. So that if someone invests early on, there's not going to be a lot of cash flow for the first 12 to 18 months because of the function of raising the capital and deploying it. And then the next phase is in years 2, 3, 4. That's really the value creation. That is where you go to work. We are promoting, we are advertising, we are marketing. And then also the construction team, they get in there and they make all the improvements that physically, aesthetically make this property attractive to our customers. And then once we've done that, where people know about us, it has great curb appeal. It looks like a reputable business and property. And then now we raise those rents and drive the value. And then we look for the low-hanging fruit of cutting those expenses, where we have some guy playing solitaire in the office at Syracuse, in the storage facility, and that's just not needed right now. We can have a regional manager plus our call center and lower that cost. So I'm dragging on with these answers, but I want to walk the investor through how it actually works, rather than just giving you surface level returns that you're going to hit a 20% return and just trust us with your money. And it's great I believe we're going to hit our 16 to 20% return. Our focus is over a 5-year period of time, because the fund's life is 5 years, is that we hit a 2 times equity multiple. So if you invest $100,000 with the cash flow that you receive over those 5 years, and then when we sell those assets, you will double your money over that period of time. And along the way, I'm proud to say that we haven't done a capital call. So throughout my career, I had not went back to investors and said, I need more money because we ran out, because this project is not successful. And there's tough times. I'm not saying that I've never lost. I mean, there's been properties where I have personally lost, or I have to incur or waive my fees or my equity in order to preserve investor capital. And that's just the reality of the game. There's very few out of the hundreds that I've done. But at the flip side is there hasn't also been a investor loss. So it's something I really hold near and dear to me. And I'm not guaranteeing that we're never going to lose, but I am going to say I'm willing to die on the horse. Like, I'm going to do whatever it takes to make this successful. And I've learned enough through the days in this industry of where you can really get burned. And each time that maybe a property didn't do as well as I thought, or a property did a lot better than I thought, like, I pick up on these things over and over, and it's just pattern recognition. And that recognition allows me to step into the next deal saying, okay, I know how to buffer this. Like, when you're buying value add real estate, you have to be able to know where there's risk, because it's silly to think I'm not going to incur some level of risk when there's a property that is mispriced in the marketplace where I'm getting a great deal. There's too much information out there now where people have access to deals everywhere that they're going to be approached. Sellers are going to be approached daily about selling. But if you're not willing to incur a level of risk on that property, then you're not going to have the potential to drive the value. But like the great investment sponsors or allocators or business CEOs, it's knowing exactly what to do with that risk and channeling it to be such an opportunity. So it's just building around, like, what specific things that I've done is just having plenty of cash reserves, being able to have multiple strategies where in that parking lot in Syracuse, we could have leased it out to RV and boat tenants. There's a high demand there on the feasibility study. We had obviously the UPS lease that's long-term and very stable. And we also had portable storage because people want outdoor storage, and we put portable units, somewhat like sea containers, and it's drive up, and contractors and residential consumers can use them. So it's having multiple options on an asset so that you're not all in. I can't stand being just this one thing needs to work out and then it's all going to be better. I'm going to get this big win. We have multiple strategies going. So to me, I lost my train of thought on this, but I hope that demonstrates, how we're trying to implement some of these strategies.
Yeah, 100%. I think you've really conveyed that well for the audience. One thing that I'm really excited to dig in a little bit here on is a core focus of Patriot, obviously, is the self-storage business. A core element of our strategy is rolling up into a singular brand, all-purpose storage. Mm-hmm. Obviously, we're top 10 storage in the Northeast, top 50 nationally. Tell me about why you elected to roll up into one specific brand. Maybe talk to some of the systems, the processes, the people, the management, the technology, the marketing, right? From your point of view at the leadership level, right? Why we chose that specific direction.
Well, yeah, self-storage itself, best attribute of this asset is low CapEx. So what that means is it's a very little cost to maintain this asset long-term. Like Warren Buffett says, he loves businesses that don't have large capital expenditures consistently hitting the balance sheet. That's why airlines are tough, right? Because you got to consistently pump money back into retooling up the plane. So with self-storage, you got a metal roof, ideally. You have a asphalt paved drive area, and you have metal or concrete buildings. Like it's pretty indestructible if you build it the right way. So that alone is the asset itself is very low intensive to feed it and pump it more capital, which I think it's a great balance with apartments or manufactured housing where there can be a lot of long-term capital expenditures over time, reinvesting in the asset to make sure it's updated. So, and we do that up front with our manufactured housing communities where it's water lines, sewer lines, roads. I mean, these things all have a shelf life. So it's just really that's its own de-risking strategy. But with storage, number one, like it is a very, very durable asset that you can count on. And it's the subscription model in real estate. It's the get your credit card number and just it keeps rattling off, auto debiting every single month. And so once we get a tenant in there, that's really the goal. It's to really boil the frog slowly, And there's nothing wrong with this strategy. I have a storage unit and I have a decent sized house, but it's just I've had them throughout my life. I don't want to get rid of some things. So the thing is, they get me in with an entry level low price, $100, right? $100 a month. I can afford that because I got like $8,000 in furniture. I don't want to get rid of. I'm going to use it someday. And then month 4, month 5, I get that rent increase, $20. All right, I can handle that. Month 9, I get that another increase. All right, another $20-$25. I'm at about 150, 145. And then on month 18, I'm at about another $20. So it doesn't sound like a lot of money, $20, right? Each every 6 to 12 months. But on a ratio, right? If you look at a percentage of my rent before, my rent just went up like 40%, 50%. So, and anyone that's in commercial real estate, that is massive. And I'm not saying that this is year in, year out, you're going to get 50% rent increases, but you're able to continue to fill these assets through marketing channels that you are working on, and where, just like the Expedia model, dynamic pricing options where someone needs the unit, you only have a certain amount of available units left. What are you going to do? Obviously, crank up the price. On that last unit, you want to get the absolute highest price. So it's very unique to commercial real estate because you can have the same units, 10 units with 10 different prices based on demand. And then it works the other way too, where the market's going the other way. Less people are moving right now. People still have a lack of space because there's lack of housing, but we turn that dial down and then you get more people in there. So I love the maneuverability in the asset class. It takes a lot of insight where dynamic pricing, like that Expedia type model, takes a lot of expertise to be able to manage 20,000 different units and take that dial. And then on your end, customer reputation and getting eyeballs on it to be that top 3 on Google. Because if you're not on that front page, no one's going to find you. And it's dialing in those levers where we bought the assets right, where we're in towns that have good median income, 60 to 100 grand for a family household income. There's good cost of housing where it's anywhere between 300,000 and 500,000 minimum for the house price there. And there's demographics where we have at least 10,000 people within an area. I mean, just the basics there so that we can draw in from that tenant pool. So with those fundamentals, like, it's just funny how psychology of the consumer works is if you have 10,000 people, like the industry standard is, there's going to need to be at least 80,000 square feet in that market to serve those people. It's the weirdest thing. Like, I don't know why, but that's the way it works out, where that supply demand imbalance is if we can analyze markets where that imbalance is off, then we can fill that void. So across the portfolio, we had to standardize it. When you have 20,000 units and we've been developing and acquiring and expanding, you have to have standardization. And we have a great partner that we worked with, Extra Space Storage, now they're the public REIT, biggest public REIT if you base it on number of stores. They bought Life Storage, to how many billion-dollar company. And it was amazing to meet the CEO, Joe Margulis, and meet all of their leadership team, and seeing how a professional organization is ran, where it's not emotional, it's not reactive, it's very standardized, it's very strategic, outstanding talent. And looking at, okay, how can we use that model where we're more nimble? We can go buy in markets that they can't buy in because they need a sizable asset to deploy their capital into. But we can still take their strategies of pricing these units in a way that really target the consumers that we can fill, where you're not filling the asset to the absolute brim, but not maximizing rents. And that's what a lot of these people do, is they think I'm 100% full. Everything's great. No, you're leaving a lot of money on the table. The 10% that's left over, the market would pay you 20, 30% more for that 10%. And you're just letting it stay full and you have no inventory. So these guys taught us a lot. And that's the foundation of the brand, is standardizing how we're going to perform for the customer. So we get fast, friendly, flexible. And then the second thing was modeling their call center, where post-COVID, right, we're in a new economy. And post-COVID now in our markets, in Maine, in parts of North Carolina, in Vermont, we have the elderly woman that understands a QR code, that feels fine calling over the phone and making a payment at this point because they're conditioned that way. They couldn't go in anymore and hand off check or cash. So now it's a great opportunity where we built up an amazing call center, great talent overseas. It's very affordable for us. These people take pride in their jobs, consistent. It's not easy. But we built a good culture even across the world, being able to cultivate that culture. And then now we make the process very seamless. And you're helping continuing to improve this process. But not only that, so we get to the point of serving the customer, helping them get into a unit. And then also the last thing is, like, now, how do we dial in on the little things around that experience? And this is what you're bringing to the table is getting feedback from their experience. How do we keep them in the unit another 6 months there and not lose them? The little dials and tweaking it. But I think the foundation is there where ultimately, even if we build the brand and no public company wants to buy us, I mean, obviously in private equity and anyone that runs their own business, there's always the alluring aspect of selling the entire aggregated portfolio or the business that you generated so much income and you're an attractive asset to buy from a large company. That could happen. It could be amazing for all our investors. But now I built to last. Like you said, like I built this company where I want to play long-term games with long-term people. And this game is, the storage game is a long-term game where you're going to have bumps. Right now we have bumps in the road, a 1 year, 2 year period. If you look at it that way, we were not losing money, but you're not excelling like we were 21, 22, where we were getting 20% rent increases year over year. So for us, it's build this portfolio to be just indomitable, right? To really last in any economic environment, to be able to continue to buy at cost basis, build at cost basis, that we continually pump cash flow. And then I think the gravy is inflation is the foundation that continues where all tides will rise. If you own real estate that actually people use, which most do, so if you buy real estate that most people use, I mean, as long as you didn't buy something in the middle of nowhere, inflation will do its job. I wish inflation will do its job. That's it. So as long as we keep printing money in America, then our rents will continue to rise. Cost to build will continue to go up, and we'll have a competitive advantage with the asset basis that we own, and that they're durable. We did the right things up front to make them last for decades. And then we'll continue to just keep meeting those distributions and hitting our returns for our investors. And that's what I saw from Public Storage. Like I read that the founder's biography, and it's, it sounds so boring, but it was actually really exciting the way that this guy built this entire monolith of a company with just one facility down near San Diego, and then went up in Pasadena and rode this industry from the 70s all the way to today, where he has key pieces of real estate in the core, the best markets all over the country that continue to just create cash for its investors year in, year out. I mean, that's exciting to me. I don't care if it's a boring business.
I totally agree with you. I mean, if we look at the last 20 years, right? Let's compare self-storage, small bay industrial, manufactured housing to the core four REITs, right? What do we see? We see dramatically higher performance year over year, decade over decade. And that's something that we've, placed a solid bet on here at Patriot. From your perspective, what does that defensibility in terms of cash flow and returns really mean for our investors that are either already in or are looking to invest in Fund 5?
Yeah, defensibility number one is know your walkaway price and be willing to walk away. So right now it's great. Right now is great because the competition has been reduced, where a lot of other investors are stepping away for a while. So, but for me, I learned, don't get caught up in a bidding war just because you love the asset emotionally, you want to buy it because it fits perfectly for your investors. It's easy to get caught up in that. So number one is we know our strike price and where we have to be to meet our returns. Second thing is buy with fixed debt. We all learn that now, and it is critical where everything we buy, we have fixed debt for a 5-year period of time. We might use a bridge loan for a 1-year period just to buy the asset quickly, in order to execute very, very fast for a tremendous opportunity. But our debt is structured 5 years plus, sometimes 10. I have to personally guarantee it at times, and I'm willing to do that because I believe in the asset. So interest rate risk is real, and we all saw that. Apartment operators bought at very low cap rates on floating debt, and now the debt is coming due in 2025, and that's where big capital calls and big losses are occurring. Third thing is don't overestimate what you can do as an investor. And I'm talking to myself, but anyone else in real estate. This is not the time or opportunity to take on a massive value add opportunity, building 100,000 square feet of storage or infilling 100-unit mobile home park or affordable housing community. Like that is a heavy, heavy lift. And I've noticed that I believe we're in a recession. GDP technically is not down month over or quarter over quarter, but still, I see the economic environment shows that the average consumer has pulled back a lot, and we can all see it out there. So right now, pursuing such an aggressive strategy to go build a big asset or convert a big warehouse into a new use or to fill an entire community of housing is not realistic. I think that it's not that it won't be successful. What are the investor expectations? What are our expectations? And being realistic. I've learned throughout the years, it's knowing in the timeline that I have, 5 years, if that's the investment horizon, and some investors have 10-year horizons, can I truly achieve what I need to achieve with the capital that I have right now in order to deliver to the investors' expectations? So to hit an 8% yield right now, and then on average over the next 5 years, plus a win of a 20% return after we've sold the assets as an IRR, it is not prudent for me to take a risk in a market that is so volatile that it may not be in the media, but it is the reality of how consumers are operating. And I think it kills the opportunities that could potentially be available where we don't have to incur that risk. We can achieve the 8%. We can achieve doubling people's money in the next 2 years, doubling my own money in the next 5 years and during the life of the fund. So let's play defense as our greatest offense and just look for these opportunities and let others make the mistakes. I've already lived them. I wrote a book about it. I don't need to do it anymore. I mean, so let's capitalize on this market right now and just doing fair deals, not trying to hit grand slams. And then that way we'll ride through this. And when interest rates drop, values always go up. And then when economic activity gets better, GDP goes up, consumers have more money, more stimulus, whatever happens in this country, man, then our rents go up. And I'd rather ride the wave rather than just fight the current through what's going on.
Yeah, and I think that a lot of our partners are excited to be riding the wave with us. You know, when we talk about access into Patriot's funds, it's not just a cash game, right? There's opportunities to 1031 to 721 in. Obviously, there's a lot of tax deferral opportunities and you know, whether that be on passive or active gains. Yeah. Talk to me a little bit about, again, we're not tax professionals by any means at this table, but we have a network of people around us that are. And so, you know, from your perspective, what might you want to tell to the investor, to our audience today about the opportunities to get into Patriot without, again, necessarily having to write a big check?
Yes. So first off, real estate is an inside game. I mean, the wealthiest people in the world invest on inside deals. So access to deal flow is number one, regardless who it comes from, us, someone else, yourself. Like that's where the real money's made first. Secondly, it's looking at the structure of the investment. Now, I've really been focusing on this a lot lately. I've been focusing on this a lot lately where people are cashing out. They've hit that maturity phase where they do not want to, they don't want to work the real estate anymore. They don't want to invest any more cash into their property. Or they don't want to have 90% of their allocations in the stock market. So what do I do next? Well, in terms of receiving a large capital gain in your asset, in some property that you have, the beautiful thing is there's advantages that you can use tax-wise that can help take that gain and reinvest it into another profitable asset without being diluted by paying tax, right? So we've been talking about it a lot lately. The 1031 exchange is alive and well. And we allow in our investments someone to 1031 out of their property and then 1031 into a property that we have here at Patriot. So it's that is a critical strategy because if you factor in all of the depreciation recapture, especially if you bonused it, and then all the capital gain that you made over the appreciation, you know, you can hit 30, 35%, depending, or 25, 30%, depending on if you took all that depreciation. It's a huge dilution of your capital. Secondly, there's something called the 721 exchange that I'm just new to over the last 2-3 years learning this, but when you sell a asset, there's something that you brought up called the 721 exchange that I learned over the past couple of years is if you own units in a company, you own an LLC and it owns real estate, and you want to sell that piece of real estate to another entity, another fund, another company. That company can buy your units and it can buy them in a way that it exchanges your compensation for your units are units of their company or of that partnership. And that's a non-taxed, well, it's a tax-deferred event. So it's a beautiful thing where I thought someday I could sell to a big public company, and maybe I will. This is the way I would want to sell, is that instead of taking the large capital gain I can then take some of my equity or all of it and then swap it or transfer it as a 721 exchange into this new public REIT or this new fund. And I can continue to get a dividend on that rather than paying 30, 40, 50% in taxes.
Let's tee this up a little bit for our audience. So let's give them a real tangible example. I'm thinking of our North Franklin property in Fund 2. Now, I know there are a few things that aren't completed on the refi side of the ball, but we certainly can talk about year one depreciation, right? Accelerated depreciation, which was about $962,000, if I do recall. So, and so from that perspective, right, what does that mean to an investor who's looking to post some additional losses to weigh down W-2 income or some rental income, so on and so forth? What does that mean for our investors?
Yeah, and that's the third strategy of what you talked about is, okay, how do I offset big, large capital gains? Well, depreciation losses, pass-through losses on your tax return, owning passive income property allows that. So how do we get more passive losses? And the way we do that is in 2022, we were able to legally bonus depreciation out of an asset 100% of that allocated amount of the building. So what that means is we get a schedule on any piece of property that we buy, and the IRS allows us to create a paper loss, a phantom loss, not a real loss that we're incurring cash-wise. And we're able to accelerate that by, people probably heard this before, but getting a cost segregation study, dividing out the components of the parts of the building and parts of the infrastructure, and then accelerating all that depreciation in the first year or two of owning it. So with this industrial property that we bought, we were able to get a cost segregation study. We bought it for $1.6 million, and we were able to aggressively drive depreciation through to the asset, to the partnership. The partners, all the capital partners, the investors received 100% of the bonus of all the depreciation. And we were able to give almost $1 million in losses to our investors. Our investors invested $500,000 of equity in that deal. So for every $100,000 an investor put in, he got $200,000 back in passive losses. A lot of our investors are actively involved in real estate, buying and selling, managing, leasing, whatever they're doing. They were able to take those $200,000 of losses and offset the $200,000 of income they brought in through real estate activities. So it was a beautiful thing for them, where that essentially is on ordinary income. That's $70,000 in taxes that they deferred off down the road. And the beautiful part of that asset was it cash flowed the next year, year two. So they got their 8%, well, actually 10% dividend on that, or distribution. And then now we're at year 3 or 4, we're close to year 4. And this is in the fund. This is one asset in the fund that flows through to all the investors, is we're able to lock in new debt. So even though we have a low interest rate on our initial debt, it was in the 5 range, we're locking in 6.5 interest, 6.75 on the interest rate. But the value went from 1.6 to 3.6. We created $2 million of value, minus out a couple $100,000 of improving the asset. So now we're at right at the 8th inning of getting the financing here. Now we should be able to pull out $1.3 million of investor capital, of capital on the asset. So not only will the investors get their $500,000 of capital repaid, but now there'll be that additional $800,000 that we can distribute back into the fund, making sure everybody's paid any more of their pref, and in their waterfall, there's 70% of the profits.
Yeah, that's a powerful strategy. And looking ahead, do you see those types of outcomes happening in Fund 5 as well?
Oh, this is the best strategy in the world. I mean, what I'd like to do, my vision is to have 10-year funds. I mean, Fund 5 is a 5-year fund. We have additional rights to extend the fund out if it's not conducive to selling at that time. So ideally, with the investor base that we have now, 350 investors, more and more of them are saying, you don't got to pay me back all the money. Just keep making returns and keep compounding those returns. So this is the best strategy in the world. The infinite return model, right? Is invest your money, generate yield, add value, and then refinance, get all your money back, and keep your money, and go reinvest that money somewhere else, and keep getting a return on the asset that you own. And now you're playing with house money at that point. So yes, this is a strategy. If interest rates go back down another 200 basis points, if we can get in the high 4s, low 5s, that'll be a game changer for the assets we already have in a lot of our funds. That's going to allow us to recap a lot of the debt that we've created a lot of value on the assets and then pull out a lot of investor capital and still cash flow on the asset.
Yeah, let's take a look into the future, right? Let's pierce behind the veil of where Jeremiah wants to go, right? And so we talked a little bit about, or peeked into the windowsill of a legacy fund. I kind of heard that as an underlying tone of your kind of comment there. And so my question for you is, when we talk about conveying assets that are performing into a long-term income vehicle, what's the benefit of that for an investor? And ultimately, how can investors learn more about future opportunities around long-term income funds, such as what will be the Patriot Legacy Fund in the future?
Yeah, at this stage of my career, and a lot of the investors that have taken the ride with us for the last 10 years, it's more now about long-term wealth creation, not about short-term pops or high yields right up front. And what I've learned in real estate is that it's so hard to find a value-add property that has a competitive advantage, a barrier to entry, where you have a strategic piece of real estate. It's very hard for another competitor to infiltrate your market. So geographically, this is the best part of real estate. The one benefit over maybe digital assets or marketing at scale is that we have a fixed piece of property that no one can duplicate within this 10-mile radius. Those are the assets that I don't want to sell off. At this stage, we did all the improvements physically. This thing has another shelf life of 20, 30 years without putting a lot of more money into it. Secondly, we have a good customer base that we built up. They're either paying their bills. They're not high delinquency. They got good cars, nice houses. I mean, they're in good shape, good jobs, consistent. We have a good operating team. We have a good manager there that lives either on site, or we have great regionals and good maintenance staff. Like, all of this stuff, it takes a long time to put into place. And the way that I've had to grow my career and continually compounding the investors' returns is buying, selling. And that's been great because we continue to find a good value add asset to put it into, and then we can do it again, tax advantaged. But now at this stage, it's more competitive than it's ever been, where these alternative asset classes are on the radar of all the biggest institutions out there. Now, the great thing is they don't play as much in our league of $2 to $10 million, where they're going out and meeting, every owner on site in the middle America. But they do want to buy large portfolios, and there's value, and there's more interest from the institutional debt side of things. So I think long term, there's a lot of opportunity in these asset classes because more institutional investors want them. The flip side is there's not a lot of mobile home parks being built. We have a 30, 40, 50-year-old infrastructure that there's latent value, hidden value in this that needs to be monetized. We're doing it. That's the foundation of this company. So the thing is taking assets that we've bought in Fund 2, 3, 4, 5, and we're going to create this value. We're going to execute on the playbook, do all the right things. At this stage, we maximize value. So the goal is find a vehicle that we can build where it's a 10-year fund with an additional 2 5-year extensions. We can go out 20 years if we need to. And the goal is to give investors an option. At that stage, we hit your 2x or what it is, or 20% return. Now, at this stage, do you want to exit and be out? And you have that right. And it's great. You move on and invest or take your chips off the table. Or the option is you can roll in or exchange in that 721 exchange those units into the new fund. And that asset, projecting based on whatever market values is, we forecast about a 6% yield, like consistently day one. I mean, it's stable, and it's very stable. There's very little value creation. Now it's more of the REIT institutional model. So that's the future for me. Is I'm exploring building that vehicle, and personally with my own wealth, I would like that vehicle, and a lot of investors that have shared that with me as well. Is where we have this really, really safe structure that's very consistent and durable. That will give investors the option of, okay, now I can consistently receive that 6%, and I can live on some of that. That's a nice check. It's better than a lot of dividends and stocks. And there's still value creation. I mean, there's still going to be some appreciation, but that is the goal where I think we'll have maybe 20 assets out of our 60, 70 assets throughout the funds that would really qualify for being the size, having the competitive advantage. having the long-term capital expenditures completely de-risks, and then all those assets go into that fund, and our investors can then compound it again and go into that vehicle.
I love that story, and I love where we're heading as a company and where your mind's at specifically. If we had to summarize a few key points for potential investors, prospective, or even active players, what do you want them to know about where Patriot's at today, where your mind is at, either on deal flow or again on future vehicles? I mean, what do you want to drive home for our audience today?
Yeah. To answer your other question and this question is, right now is not the time to get cute. Right now is not the time for me to do something innovative or exciting. It's going to be very boring from this stage out. So I want investors to grade me on how are the numbers performing. Let's get back to the fundamentals. I could say a lot of punchy taglines, and affordable housing is sexy, and there's a lot of different unique last mile distribution facilities and all these different retail mixed use concepts. Those are great. I mean, people will make money. But for me, I know what I do well, and I'm going to stick to the fundamentals and just continue to knock out the reps, where we're going to find the same type of assets over and over. So just follow my journey, follow the assets, and grade me on a per project basis. Why would this guy invest in this, and how did it turn out? And then look at, regardless of what it looks like and regardless of how you compare me to some other polished, fancy fund, it's like, let's look at how the underlying assets are performing. And that's, NOI. Am I generating cash flow on these assets? Is it generating more value? And am I generating cash flow? And that's what I want to be very transparent. And there's challenges. I mean, I've had challenges in funds and in assets, but yet I've had big wins too. So it's like, have a realistic, sober look at what's going on in the marketplace right now, and where does Patriot fall in line with how commercial real estate's performing. And instead of getting greedy and thinking, okay, I can hold out and do something that's going to generate a 3, 4, 5x, and I'm going to invest in some risky project, like, let's look at just consistent, durable returns. And it's not about forecasting 5x. It's about hit my 2x every 5 years. Is this guy performing? Can I hit my losses that I'm supposed to get on my tax returns? And he gets his K1s in on time. Are they quarter over quarter executing even in a challenging market? Now that don't get caught up in all of the things that you do, where you make things look really pretty in the marketing side of things, and with a lot of podcasts and funds and institutional funds and debt instruments out there. There's so many different vehicles that people can invest in right now in terms of crypto and a lot of private equity and unique concepts and VC. But let's look at the basics, and the basics work. So I'm going to keep driving the basics, and I'm going to keep reporting, good, bad, or ugly. This is how we did, and grade me on that. Don't grade me on something that looks fancy but isn't actually performing.
Yeah, don't get blindsided by the beauty, right?
Right.
Ultimately, there's a mask that, once we unveil certain assets or certain funds or certain sponsors in today's environment, right, they're not always pretty. And so I think you hit that nail on the head. One last thing I'd love to touch on is your perspective on radical transparency. I know it's a phrase that I hear you say all the time, whether it's from a reporting perspective or whether it's from how you run your business. What do you want our audience to know?
Well, like I said in the jockey test, good news, bad news. I want to know the news. I want to know what is the update. And we put a lot of resources, time and energy into reporting. I mean, that it's something anyone that's in real estate out there know that it takes a lot of work to put together a finance team, put together quarterly reports, get all the deliverables from the asset managers, get all of the marketing reports on your end and how we're performing. Now, all that stuff is nitty gritty stuff that a lot of people and our investors don't dive deep into, but it's the fact of compiling it into a concise narrative of, this is how your investment's doing. This is your investment statement. This is the future plans of what we're going to be driving towards. And these are the obstacles and challenges we're incurring today. I think, so for me, it's just consistency, and it's continuing to build that relationship through communication with our investors. And it holds us accountable to having to hit our metrics. I mean, my whole team knows, just like a public company, we have our quarterly earnings or our quarterly reports that we have to drive to all the external stakeholders in the organization. So I think it's, things are going to get maybe rougher, who knows, for the next 6 to 12 months. So instead of just putting your head down in the sand and not really looking at how are your investments performing and just hoping or trusting that it's all going to work out, just doing a little bit of homework and seeing, okay, this is what's really going on, and asking questions and really being active in your investments, or don't look at them and take the ride. But that's the thing. I think it's important right now that even if the communication is there, I think is super important. So I hope that answers the question.
Yeah, it does. So no one has a crystal ball. And if someone is interested in our investment thesis, the ideals of durability and resilience, turning boring into beautiful outcomes, if these things resonate with our audience, how should they get in touch? Who should they contact? And ultimately, how can they start to explore making an allocation with us at Patriot?
Well, the website, patriotholdings.com. You're building a beautiful website for us. So the experience for the investor will be much better, but there's a lot of assets on there now. You can check out Patriot Fund 5. So patriotfund5.com has the OM and the summary deck. And then also come to Vegas. We're at 4007 Dean Martin Drive. So right by Caesars. So you're welcome to come in anytime and visit us throughout your summer vacation. And then also this podcast here, Finding Your Edge. And then we'd love to give you a copy of my book. It's called Finding Your Edge, How to Win at the Game of Commercial Real Estate. It's on Audible. I'd love to just connect with you in a way where you understand why I do what I do. And I'd love to get to know you and have our team share with you what we do in order to see if it's a great fit.
That's fantastic. And in certain instances, should they reach out directly to either yourself or CIO Shane Stokes to continue the conversation?
So reach out to Shane Stokes. He's our CIO, Director of Fundraising, so he can answer all the questions for you. And I'm happy to hop on a call as well. So in the comments below, we'll put a link to contacting both of us, and we can book some time on the calendar. And I'd love to just get to know you in person and hear what you're up to and see if we can solve some problems. Yeah,
and what's exciting as well, Jer, is we're going to start to roll out some quarterly webinars, both for active investors as well as new investors or new prospective investors. And so you'll be also leading conversations on that, in the aggregate for people. And so maybe give them some insight as to what they have to look forward to.
Yeah, I'm excited for you to help create our quarterly reports calls to be more available to people that are interested in Patriot and seeing how we're performing and just seeing how that standard that we've set compares to other investment opportunities. And then you can follow the journey of what are we buying? What are we selling? How are we doing? And what are some of the strategies that I want to push on as the market shifts?
Yeah, I love that. So be on the lookout, everyone, for a few new looks on the website, for new podcast episodes, for new webinar opportunities, for lunch and learns, meet and greets, all of the fun things that you'll ultimately get to experience our team in real life, in person, get to ask tough questions, and ultimately, we're looking forward to connecting with you all in the future.
Rick ran this one. I think he nailed it. All right, guys, wrapping up another episode. I'll see you next time. Finding Your Edge. For more information on commercial real estate investing, go to patriotholdings.com. Thanks for listening to Finding Your Edge.